Good evening, everyone, and welcome to our webinar presenting our equity strategy for the second half of this year. We hope you've had a good weekend. And as of course, the name suggests, we are quite positive in terms of the equity market, and we do think it is go time right now, particularly with the developments that we have seen over the last week. So we will talk through some of our key reasons for why we are positive in terms of the equity market, a couple of risks that we might see more so in the medium term rather than the short term, and also in terms of our stock picks and what sectors we think are interesting to look at right now and enter in this very positive kind of period that we do expect. At the end of the presentation, there will also be a 15-minute Q&A session. So please send in any of your questions to the chat, either to myself or the Capital Alliance chat box. We will also, at the end of the session, if you are not already a client of Cal Securities, we also will have about a 10-minute explainer in terms of how you can open your account online. And to explain that process, we will have Stephanie on the session with us at the end as well. So please do stick around till the end in terms of getting some of those details overall. So just to kind of start off, as I mentioned, we are quite positive in terms of the equity market. We do think that the developments of the last week, particularly with the conclusion of the domestic debt restructure, is one of the key catalysts in terms of bringing in quite an upward movement in terms of the overall market as a whole, but also in terms of the economic indicators also turning positive and expected to turn more positive in the future as well. So in terms of our overall view, we do think that we will see the ASPI reaching levels of 11,500 to 12,500 levels by end of 2023. We've seen it kind of moving up and down in the last couple of months. The last high it reached was towards the start of last year, hitting around 13,000 levels. So we do think that it is going to go quite close to those levels, but see a very strong upside from where we stand at right now. Of course, as I mentioned, the key catalyst is that we have seen domestic debt restructure clarity being provided on it, and that has weighed on the markets in the last year, weighed in terms of both investor sentiment as well as foreign investor sentiment towards Sri Lanka as well. And now with that clarity being provided, we do think there is strong upside for the market, and we do think that this is a great entry point if you have not already kind of locked in terms of some of your stocks. This is a good time to enter right now and see some strong returns going forward. So in terms of why we really expect it, we do think there's going to be a shift overall in the market. We think that because interest rates, you're seeing it being on a downward trend right now, and you can see this graph here in terms of the green line, you can see that sharp downturn that you're seeing, and we expect it to continue much more in the next couple of weeks as well. And as a result of that, you will see equity market returns kind of starting to pick up. And we have seen this in the past as well. So even in the end of 2010 cycle, where interest rates started falling, you saw that sharp pickup coming in on the ASPI. Again, in terms of 2014 period as well, where there was an easing cycle there as well, interest rates coming off. Again, that was a strong period for the ASPI. And of course, the most recent one, which was the easing cycle in 2020 with COVID, where there was a lot of liquidity in the market, and that really spurred growth in the equity markets and returns in there as well. So similarly, right now, with interest rates moving into a downward cycle from the very sharp upward cycle that we saw in the last year, we do think that this is going to usher in a period of growth for equity markets. So speaking in terms of our reasons for why we expect interest rates to decline. So overall, we expect interest rates, and by this we mean our reference rate here is the 12-month Treasury bill. We do think that it's going to reduce to below around 12% levels. It is already standing at about 18%, which is a sharp decline from where it was a couple of months ago. So a couple of reasons that have, of course, helped this has been that inflation has been coming off quite sharply. It hit around 70% levels towards the end of last year and started coming off. But of course, as we saw that second half starting to increase a lot last year in terms of inflation, this year as well, the base effects of that are starting to get factored in, with inflation being reported at 12% just last month. And we do expect it to start going into single-digit levels from next month onwards. And so if you're looking at an inflation targeting framework by the central bank, which is what they're following right now, looking at forward inflation or inflation expectations, there is quite a bit of space for the central bank to start cutting rates more aggressively, similar to what they did in the last month with the 250 basis point cut. So with that, of course, in terms of how that reflected on the treasury bills, we saw the one-year T-bill falling very sharply from 25 to just above 20% levels, and now standing at about 18% as at the last auction, and reducing. And we expect that to kind of come off much more sharply this week as well. We do think there's going to be a sharp reaction to the clarity provided on the domestic debt optimization program, and we'll see these rates coming off quite sharply this week itself. And then if there is a policy rate cut that is announced on the 6th of July, that again spurs it further to go down thereafter. Thereafter, we also expect further policy rate cuts. So we expect a total of about 400 basis points reduction in policy rates in 2023, or the second half of 2023 rather. So policy rates would then stand somewhere around 9 to 10% compared to the 13 to 14% it is standing at right now. So as a result of that, with further policy rate cuts in the future, as well as inflation reaches very close to kind of zero levels, very possibly going below that as well, towards the end of the third quarter, start of the fourth quarter, we might see further policy rate cuts, which then again allows T-bill rates to fall much further, and the overall yield curve to fall as well. So that is one of the reasons, inflation coming off. The second reason in terms of why we expect interest rates to reduce is the conclusion of the domestic debt restructuring. So as I mentioned, we've seen this happening in other markets as well that have seen domestic debt restructures in the past, as well as in the recent past, as well as further on previously. So for example, Ghana being the most recent example, you can see that with the finalization of their debt restructure program or the debt exchange being completed, we saw their bill as well as their bond rates actually coming off quite sharply, about 10 basis points it came off. Bonds are less traded because they have been included in the debt restructure program for Ghana, but you can see without any risk on treasury bills, what has happened in terms of their rates. You can expect that both in terms of bills as well as bonds in terms of Sri Lanka's cycle. In terms of Jamaica as well, a little bit of an early example. So they had their restructuring in 2010, and you can see that closer to the period where the restructure was being finalized, that there was a reduction in terms of interest rates, again, about 12% reduction. So you can see that these are very positive. So in terms of the case of Ghana, while it is more recent and there has been a much more messy exchange compared to what Sri Lanka is actually going through right now, they still saw a reduction in interest rates. And in fact, in terms of the equity markets as well, the equity markets picked up quite strongly following this debt exchange program as well. So for Sri Lanka, since this is much more of a smoother process as we see it right now, compared to how Ghana has kind of handled it, we do think that there is a lot more upside for Sri Lanka going forward. And the third reason in terms of interest rates falling is, of course, that there's an improvement in terms of market liquidity. So you've seen central bank action that has been taken in the recent past, leading to a reduction in the liquidity deficit that has been seen in the market. And this, of course, means that with the reduction in the liquidity deficit and eventually possibly turning positive, because we're going to see more dollar inflows coming in as well. So here we have a couple of expected inflows that we do see in the second half of the year. The IMF's second tranche, which is due to come in around September, October, after the first review is conducted. ADB funding, which was actually just received in the last month. World Bank has also agreed to provide 700 million. So once that comes in, that again, the 500 million of it is offered in terms of budgetary support. That also helps in terms of spurring on market liquidity. And in terms of portfolio investments, our estimates based on the CBSL numbers brings the first 5 months of the year to about 400 or so. Given that some of this has been investments in treasury bills, and there is some risk of it kind of going out again, because these are more short-term instruments, depending on the risk appetite of some foreign investors who also then might decide to switch to bonds as well. Still, we've gone with a conservative number here of about 420 million in terms of portfolio inflows. It can very well be much more positive going forward as well. So as you can see, in terms of how this affects the equity markets, periods of positive liquidity or increasing market liquidity, you can see results in increasing returns in terms of the ASPI. So both in terms of the 2014-15 period, early in January, early in 2020, and of course now what we're expecting going forward as well. So in terms of the investor's point of view, right now equities are again positioned a lot more attractively. As you know, in terms of capital gains, this is still tax-free despite all the changes that have happened in terms of tax regime over the past year. We've seen, for example, taxation on fixed income securities in the form of withholding taxes being implemented at 5%, but on top of that, there is an expectation to pay. So we've gone with the highest tax bracket here of 36% in terms of what someone would need to pay in terms of their interest income in any of these securities. Here we've gone with the fixed deposit rate, the 1-year fixed deposit rate, and you can see that there is quite a downward trend, this dark green line coming in more recently, and now with deposit rates coming off even more strongly in the last couple of weeks and possibly going forward, which can hit easily single-digit levels. When you adjust that for taxation, you find that you might actually incur the post-tax return on your FDs might actually be as low as just above 6%, which is the kind of rates of return that you would have been getting in 2021, in the 2021 period. And this, of course, means that equities now being tax-free becomes a lot more attractive for investments. And we can see this relationship that it has had in the past. Of course, when interest rate returns were very high, or fixed income returns rather were very high last year, we saw equity markets performing poorly. But now we expect that liquidity to shift in terms of investor sentiment as well, moving back into equities and out of fixed income securities to some extent because of the lower rates of return that are offered on most fixed income securities right now. So another reason, apart from interest rates, is that we do think there is a market re-rating that is warranted. We've seen, for example, here we've provided a chart in terms of the inflation-adjusted market cap. And you can see while there has been a growing disparity in the last several years, this disparity actually increased substantially over the last year because of the high levels of inflation. And the market really has not adjusted in nominal terms to this. So we can see that in real inflation in terms of real market capital, you can see it's trading at a 58% discount to the nominal compared to, for example, a 17 to 20% discount that it had in about 2019 or so. So there is a re-rating that is warranted in the market overall. Of course, to support this fact is that the market is also trading at a very steep discount. And this is again something that we've heard time and time again in the past year, that Sri Lankan market is heavily discounted. It's trading at a PER of just 5 times versus a 5-year average of 9 and a 13-year average of 14. So in terms of what we would expect, we would be expecting maybe a PER on a base case of about 8 times to be a little more conservative for the second half of this year. Yes, corporate earnings might decline overall for the year, but we do expect with interest rates coming off that you'll start seeing an improvement in corporate earnings slightly to the second half as well. And all of that kind of factoring in, there is, again, an upward adjustment that is impending. So speaking in terms of recent times, of course, there has been quite a bit of resistance if you're looking at technical indicators that has kept the market relatively volatile, not kind of beating that 10,000 mark. But now we do think that there is quite a lot of strong momentum that will allow the market to actually breach the resistance levels, the next one being at about 10,131 and thereafter a stronger one at 10,500. We do think that the market now has momentum enough in order to break these resistance levels as well. And we do think it is poised in terms of moving upwards, even on a technical indicator side. So the third reason, of course, is that we do expect that there will be increased foreign participation in the market overall. We have seen this declining quite sharply, particularly just towards the end of 2019 and then into 2020 as well, because not just of COVID, but also because our country ratings were being downgraded at that time. And of course, Sri Lanka became a much more risky market in terms of investments. There was overall a risk-off mode globally as well, but Sri Lanka's own problems kind of kept foreign investment relatively low, not just in terms of equities, but also in terms of the government securities market as well. And you can see in terms of the turnover contribution as a percentage of the overall market turnover, we are standing at about 16% right now. Whereas, in the recent past, we've also been at levels of single-digit levels in terms of foreign turnover to the market contribution. And whereas on an average over the last 20 years or so, this has been at about 32%. And in fact, there are several times when it has hit much higher levels of over 70% as well in periods where the market was really strong. So we do expect that at least it will hit these 30% levels, if not more. But we do think that overall, Sri Lanka being at a cheaper valuation regionally as well, you compare it against the region, I think Pakistan is the only one that is valued cheaper than us right now. So we do think there is a good value proposition even for foreign investors right now to want to get into the local market. There is less risk in terms of depreciation risk as well compared to what was factored in, say, 1.5 years ago. So right now, in terms of our expectations for depreciation as well, in fact, it will be an appreciation if you look at it on a year-on-year basis by the end of this year. But we do expect a little bit of depreciation in the second half of this year as a result of us starting to kind of pay off some of the loans that we have due or that we have deferred so far. So we do expect some level of depreciation, but this is not as much compared to what an investor would have had to factor in a year ago, where we saw over 40% levels of depreciation. So a 5 to 6% level of depreciation is something that investor investing in a country like Sri Lanka is quite used to and would be factoring in this kind of environment. So we do think it's attractive for foreign investments as well, and there will be push on the foreign side. So this is again something we've seen in other countries that have been through some type of restructure as well. So these are not necessarily domestic restructures alone, but also external as well. Some of these countries have been through both domestic and external, similar to Sri Lanka. And you can see that in terms of equity investments into those countries, there is a positive shift in the year after a restructure and the year of restructure as well. So you can see that this starts to make a turn right after a year of restructure. So similarly, we expect that to happen for Sri Lanka as well. It may take a little more time compared to local turnover picking up, but we do expect it to start coming in towards the end of the year. So even if you're looking at foreign holdings in the CSC as a whole, on average in the last 20 years or so, it has been about 4.6 billion. Right now, we're standing at about 2.6 and a little above that. So we do think that it has space to kind of reach at least its historic averages in the near term, given the positive developments that we have seen. And with that, of course, moving on to the positive developments in terms of the overall economy, we're seeing that a lot of the indicators on the macro side are turning much more positive, much faster than even we would have expected. Inflation has come down beyond the CBLC's expectations and below the IMF expectations as well. GDP growth is expected to start turning from the second half of this year. We expect it to end the year at about negative 1.5%. So it's slightly more positive compared to the IMF expectations of about minus 2%. So rather the CBS's expectations of minus 2%. And we do think there is a possibility that this indicator also overshoots the CBSL's expectations, which is why we think it's going to be more of a 1.5% kind of reduction for this year. And thereafter being spurred on to the next year to about a 3%. And thereafter we could probably see kind of moving into averages of 4% growth as we have seen in the past periods. So in terms of the relationship, again, that GDP as well has in terms of the ASPI. So we see a very strong relationship in terms of a 1-year lag of GDP compared to average ASPI returns. So the market is a forward indicator of this ASPI of the GDP growth that we would expect to have. So since we do expect GDP growth to start turning from next year, and in fact from the second half of this year, this also points towards the fact that the ASPI will see an increase. We'll see an increase within this year and then improve thereafter for next year as well. So in terms of a few of the other indicators that have turned positive, we can see that in terms of consumer as well as business confidence, there is a sharp improvement in the last couple of months. In fact, consumer sentiment or the consumer expectations index is standing above even pre-crisis levels. So this really bodes well in terms of volume recovery for a lot of consumer companies. And again, that's one of the sectors that we are quite positive on right now. In terms of business sentiment as well, this has started to turn again. It's higher than pre-crisis levels. So this again bodes quite well in terms of corporate earnings and how companies will be looking at investments going forward and in terms of their outlook overall on the economy as well. Fuel consumption, another indicator here. Of course, last year we were kind of at the lowest point 1 year ago right now. But of course, even with the implementation of the quotas and so on, we can see that fuel consumption overall has actually picked up compared to April of last year, which was just before we completely ran out of fuel in the country. So you can see that this indicator also once again proves that we're seeing increased economic activity. There is a lot of local tourism also happening as well. And overall business activity has kind of normalized. And we're already seeing that even on the streets as we go around. In terms of the Purchasing Managers Index, again, this is a very strong indicator or strong forward indicator in terms of GDP growth. And we can see that it has started to increase both in terms of manufacturing as well as in terms of services. Services, of course, has seen a stronger pickup compared to last year when there was reduced mobility. This year, we're seeing it being more normalized. So you can see that very sharp increase in terms of the PMI of services, which is the Purchasing Managers Index. In terms of Purchasing Managers Index for manufacturing, it's standing a little bit higher compared to November 2022, which was about 6 months ago. So this indicator is again quite positive. There are a few sectors, I think, that are weighing it down slightly in terms of the overall, in terms of the industrial component of it. But right now, compared to 6 months ago, we're definitely at a better position. And this indicates that forward volumes and so on will be much better. And again, in terms of the external front as well, you can see that there have been quite a bit of positive developments. You can see tourist arrivals have started picking up quite strongly. Of course, this quarter is a lower season, which is why you're seeing the latest reduction in numbers there. But towards the end of the year, when we move into the winter season, we do expect these numbers to be quite strong. And these are indications provided by in terms of forward bookings as well. And we see that being very strong towards the end of the year. And this, of course, means that your tourism earnings are higher. We also have seen remittances being recovering to a faster level compared to what we expected. It's hit above 460 levels in the last month. Of course, seasonally, April and March are higher, but we've seen these numbers continuing to be quite high above our expectations once again. So a lot of money is being channeled through the formal systems and it's returning back into the formal systems, which is a very positive sign right now in terms of the external side. And this, of course, has meant that our balance of payments has been positive in the first 5 months of the year. Part of the reason, of course, is that we haven't been making our external repayments, but there are also a lot of positives on the other side that has kept the current account a lot more positive as well. But also another indicator, which although is negative in terms of the external balances, is that our import conditions have improved. So you're seeing that we are back at kind of May 2022 levels. This, of course, is a steep increase from where we were in around October, where there were very constrained demand conditions. There were still some issues in terms of dollar liquidity at that time. All of these constraints have now kind of come off. Demand is starting to improve a little bit. We're also going to see further import restrictions coming off in the second half of the year, along with what the IMF expects in terms of these being temporary measures. We do think that those restrictions will start to come off and then again spewed by further demand that will see this picking up as well. So all of these kind of go hand in hand. You can see that in terms of the macroeconomic indicators overall, Sri Lanka is definitely starting to turn a lot more positive and a lot faster than both the CBSL as well as the IMF's expectations. Along with this, we can also see in terms of credit growth. So credit growth has continued to be negative in the last several months on a month-on-month basis. This has, of course, been due to the fact that banks have been less willing to lend because of the high non-performing loans or stage 3 loans as they reported. It was as high as 13.3% in May. And this has, of course, kept banks from wanting to kind of increase their loan books, but also high interest rates meant that the demand for loans was a lot less. But now with interest rates coming down, and of course, the recent numbers, if you look at the graph on your right, you can see that the willingness to lend by banks as well as the demand for loans have started to turn positive. And this means there's an increased willingness. So this kind of points to the fact that we will see an increase in private sector credit growth going forward. And again, private sector credit growth has a very strong relationship with average ASPI returns and in turn GDP as well. So with banks being more susceptible or more or the credit appetite increasing and banks being able to actually start lending and willing to lend a lot more, we can start seeing private sector credit to start to pick up. And this again bodes quite well in terms of the ASPI overall. And finally, in terms of corporate earnings, you can see that corporate earnings have seen a very sharp decline in the first quarter of this year. This was partly due to the fact that demand conditions kept top line growth quite slow despite the inflationary impacts. And we also saw very high interest rates, AWPLR in excess of 20% for a majority of that period, and the increase in taxation coming in as well. So even on a top line perspective, because personal income taxes were increased from January onwards, we saw that top lines were constrained of companies, but also in terms of PBT affected by finance costs, and then in terms of profit after tax affected by higher tax levels that pretty much all companies had to face in the last couple of months. So we do think that there is now with interest rates coming off, there is space for corporate earnings to start growing. So you're seeing on one hand, economic activity is starting to increase and start kind of normalizing. So that will improve top line growth. But then again, in terms of finance cost, you can see that if you kind of adjust the last quarter's earnings for about 500 basis points reduction in the lending rates, there's a substantial saving that companies would have going forward, and this would be amplified with interest rates coming down even faster in the future. So in terms of how AWPLR adjusts, of course, it has been slightly slower to adjust compared to, for example, the T-bill rate or in terms of deposit rates, but this will also kind of come down a lot more sharply, and we'll see it kind of below 15% levels by the end of the year, which then again means that there is prospects in terms of bottom line growth. We don't expect changes in terms of taxation, but we do see these two factors of economic activity improving, helping top line growth, as well as finance costs reducing, helping bottom line growth to improve corporate earnings from about the third quarter onwards. So those are the main reasons why we are positive in terms of the overall equity market. And we do think right now is a good entry point in terms of getting in terms of getting those strong returns that we do expect to see over the next 12 months. So speaking in terms of some of the risks that we see in the horizon, a lot of these are not really short-term risks, but are certain risks that we hear from both clients as well as, in terms of society as well, and risks that we have faced in the past that could emerge once again in the future. So as I mentioned, they're not necessarily short-term risks, but risks that can kind of pop out at any moment. So we do want to kind of be aware of these risks and acknowledge them as well. So the first one, of course, is in terms of political risk. And this again has been something that Sri Lanka has continued to deal with in the past. So if you look at it, for example, the next cycle in terms of presidential elections can be called on after November of 2023, even though the tenure of the current presidency will end in 2024. So anytime after November 2023, there is a possibility that we can have presidential elections. The positive momentum created by these developments on the economic side could encourage the president to maybe call for early elections and use that momentum into the election as well. In terms of parliamentary elections, there is a little bit more time, and that's more towards 2025. But of course, the president again can call that early if he wishes to. So these are the timelines in terms of the forward elections, but in terms of the parliamentary structure as well, we do see that despite, of course, in terms of the SLPP, SLFP majority, there is one right now. But we have seen in the past, of course, with elections, things tend to change. We have about 30 seats in terms of which have aligned with kind of the SLPP faction that can kind of move around. And then in that case, you can see that the parliament would not really have as much of a majority if they want to get certain proposals through. So that is something in terms of the economic or the reforms side of things that can delay certain things if there is no proper majority in parliament in terms of getting some of the much needed reforms through. So these are kind of the political risks that we can see that might keep market a little bit volatile. We don't necessarily expect any of that in the near term, but it is something to kind of keep and consider. Another risk, of course, is in terms of fiscal tightening. We do think a lot of the changes that have been implemented thus far have been quite positive in terms of reducing the fiscal deficit that Sri Lanka has. But there are certain other measures that will need to be taken as well. Again, we think a lot of it has happened already. There will be very few or far in between tax increases. Of course, there are certain sectors that are targeted, as we saw in terms of the excise duties that were increased in the last weekend. But in terms of IMF recommendations, the next bout of tax increase, or in terms of a new tax, is on the property side, which is the property tax, which they expect to come in 2025. So it's not necessarily something that we see in the next 12 months, although the priority right now of the government and the Ministry of Finance will be really in terms of widening the tax net rather than increasing certain tax rates, which have already kind of increased, we think, to an upper limit in some sense, in terms of helping us increase our revenue to GDP, which is something that we have struggled with in the past. And of course, last but not least is the global risks. Sri Lanka is not isolated from things that go on the global front. We have seen periods in which high interest rates have led to portfolio outflows. Right now, we don't see that as much of a risk because we don't necessarily have a large quantum of that right now. But this is something that if, for example, the Fed decides that they're going to further increase rates, it might keep investors away from Sri Lanka because the differential between investing in Sri Lanka and taking on, for example, exchange rate risk might not be as favorable compared to the rates that are offered globally. So these kind of things can keep foreign investments from coming in at a faster pace, but also overall, it can kind of affect certain export companies, for example, if there are continued recessionary conditions, if volume growth and demand conditions globally are quite slow and continue to be quite slow as they battle with inflation as well. This can keep certain export companies, for example, and their earnings under pressure for a longer period of time. And of course, in terms of commodity prices, we've seen this being a major issue over the last 3 years, first with COVID, and then in terms of the Russia-Ukraine war, which was at the start of last year. This affected our commodity markets very steeply. It affected our import bill very steeply. And also in terms of making it very difficult in terms of companies to procure their products, and also making it that much more expensive. So all of that together was what kind of factored in. It was almost a perfect storm when we went into the crisis last year, but now a lot of these indicators have eased off. But the risk, of course, remains if there is certain geopolitical tensions that might pop up, that might put a little bit more stress on this side. But right now, this, of course, is on a downward trend, and we see this more positively in the near future. So that's in terms of our overall equity strategy view. So to summarize it, we do think that equity markets are poised really well in terms of a growth period going forward. This is the main reason for it being that interest rates are coming off. And we have seen clarity on the debt restructure, which are two of the key things that markets have been looking for. But there are certain risks to keep in mind, although we don't see them as being near-term risks, but things that we just have to kind of be aware of and kind of prepare for in that sense as well. So in terms of our stock picks, we're going with 3 main themes for this next 12 months. One is the companies that will see a benefit from a recovery in economic activity. Like I said, we expect GDP growth to start increasing in the second half of the year. Second is companies that benefit from the declining interest rate environment. And third are the counters that have been negatively impacted by overweighting of risk factors in the past year. So to speak to some of these main kind of sections, we have, of course, in terms of economic recovery and economic activity normalizing. As I mentioned before, we expect GDP growth to be at about 3% next year, starting to turn positive from second half of this year. And you're also seeing consumer sentiment indicators turning quite positive. So as a result of that, we are quite positive in terms of consumer and capital good counters. So we have Cargill, CCS, CTC, Disti, HHL, Chevron, Mills, as well as Sun within this category. Towards the end of the year, tourism is also expected to start to pick up. And we will see this in a much stronger way. I think 2024 is going to be a really great year in terms of tourism inflows and tourism earnings. And within this, we picked Ahun as well as KHL, although we do see that there are benefits that a lot of the hotels can face. So these companies are right now trading slightly below book, which is why we keep them within our recommendations. And in terms of a forward book value as well, we think there's space for a re-rating on that side. The others, of course, in terms of economic activity recovering, is that the counters that are relatively foreign heavy, that have seen foreign investments in the past, that have slowed down a little bit in the recent times, that could start seeing more interest going forward as well, because this can really store big volumes that can push up these share prices. So here we have CTC, Dialog, DIST, Mills, JKH, as well as Sun within there as well. So a lot of these counters, once again, are trading at a steep discount also. So in terms of discounted, sorry, I missed a slide there. In terms of the counters that benefit from declining interest rates, so one is that we expect finance companies to actually do quite well in this period. So kind of reverse of what the banking sector experiences in a downward interest cycle, finance companies, in fact, have an increase in their margins in a downward interest rate cycle because of this, because of the lag in terms of how things adjust for them. Also, we've seen that more recently they've kind of changed in terms of their allocation, in terms of their portfolios. Certain companies like Elfin, for example, having very high allocations towards gold-backed loans, and this again being this as well as the other collateral-backed loans that they already have in their portfolios bodes quite well in terms of finance companies. So the three that we have picked here are Elfin, BFin, and CFin. So companies that also benefit from declining interest rates are those that were most worstly off affected in the last year with high interest rates. So for example, where on an EBIT basis that they were really facing struggles, although on an EBIT basis they were quite positive, but after finance cost where they were really struggling to deal with that. So these companies here again, kind of an overlap in terms of some of our other counters as well. So for example, certain hotel counters, as well as the supermarkets and the consumer space had a little bit of trouble in terms of dealing with their finance costs. Haley's as well is another one where we see quite a strong pickup, because we see that they had the largest thing that weighed them down last year was in terms of interest costs, and that risk coming off can really help them in terms of their bottom line improvement. And another, of course, is companies that have maintained very high dividend yields and have typically maintained high dividend yields, because you're going to see that even with a tax factored in, which is around 15% on dividends, you can still see that return being higher than, for example, a 1-year FD rate, for example, which would be priced around 6 to 7% once you factor in taxes. So CTC, Dialog, DIST, again, Elfin as well there, Chevron and Mills are companies that typically have in excess of 15% dividend yields, and these are ones that we expect to kind of continue going forward as well as things pick up. Again, a lot of these companies are companies that fall into certain other categories, so they are positioned quite well right now in terms of providing their dividends as well. And thirdly, in terms of overall discounted counters, so here a big one is the banking sector. So this is a sector that again we are very, very positive on right now. We do think there was quite a steep discount that they have been trading at because of the risk of not just domestic debt restructure, but also in terms of the external debt restructure. And this has kept banking valuations quite low over the past 2 to 3 years. So right now, the whole banking sector is trading at about 0.4 versus historic averages of above 0.7. It has seen a little bit of adjustment in the last couple of weeks in the lead up to this conclusion. But right now, given that the risk of the domestic debt restructure on the banking system is off or alleviated rather, we expect this sector to see a strong repricing. We think the entire sector actually is positive overall, but we do see these as being some of our key picks, and we do have valuations for some of these numbers as well, which provide returns in excess of 50%. So we do think the banking sector in particular right now is something that is positioned very well to move very fast with the conclusion of the domestic debt optimization program. And of course, other discounted counters, for example, Dialog, Hemas, JKH, as well as Mills, again, a lot of them trading around 0.5 book times, even in terms of Hemas being a consumer company. They are trading well below in terms of PE ratio compared to what they should be trading at. So you see that these counters have been quite discounted in the last period, and as a result of that, we'll see a repricing going forward. So these are our three main themes over here in terms of our stock picks. I'm happy to take any questions right now. If you have them, please send them across into the chat. There's a question on whether we can expect another debt-free structure in the future. I think it really depends on if we do this current one right. I think at present, the momentum or the developments that we're seeing are quite positive to indicate that if we do this right, if we take the adequate fiscal measures as well, it doesn't just enter a debt-free structure, but we have to kind of follow on in terms of further making sure that we contain our fiscal deficit, that we don't go out and borrow too much again. So these factors are also going to contribute in terms of whether we go for another debt-free structure or not. But right now, signs point to the fact that we will not need one, at least not in the near term. Of course, things can change in another 5 to 10 years. That's something a little bit difficult to call. But right now, we don't really see the possibility of that because things are moving in a much more positive direction compared to what we would have expected. So in terms of, there's a question on terms of how we can elaborate on companies with high dividend yields performing better. So it's not necessarily that we expect those companies to perform better, but rather that the return on that is a lot more attractive right now compared to a return, for example, from fixed income securities. So it's not that the companies themselves will benefit, but rather that the return you get will be higher compared to reinvesting in fixed income. There's a question on our views on the construction sector right now. So on construction, we're not yet seeing it being very strong. We do think that interest rates would need to come off a lot more strongly. We do think that there's a possibility that at some point in 2024, things can start to pick up. But for right now, it is still quite constrained because if you think about it in terms of someone, just in terms of layman's terms of investing or rather dealing with the crisis, they would first want to kind of adjust their lifestyle to what it was before, kind of deal with the essential goods, which is where some of the consumer companies, we are positive on, like car goods and CCS come into play, and thereafter kind of pay off their loans, which is where, NPLs are expected to reduce, and thereafter kind of move into more investment side of things, which is larger scale kind of projects, renovations, as well as construction coming in. So we do think that this sector will benefit, but not in the near term. We do think that there is a little bit more time before the construction sector as a whole starts picking up. There are, of course, certain counters within that, which still quite positive. For example, some of the cable companies are still quite positive because they're dealing with larger scale projects right now that haven't necessarily had as much of an impact on compared to its retail side. Those companies we are quite positive on still at the moment. But as a construction sector as a whole, because of the reduction in overall investment, we do think that interest rates have to reduce more further, and in people's appetite to actually start more construction related projects has to increase a little bit further before we see the construction sector starting to pick up. There's a question on why we have not picked other banking counters such as NDB, DFCC, Ceylon, and PABC. So as I mentioned, we are positive on the entire banking sector. Right now, we do think that the entire sector will see a re-rating. So we are positive on some of these counters as well. But if you look at it, for example, from a liquidity basis of, in terms of public holding, as well as the turnover overall, the other counters that I mentioned in terms of Combi, HNB and Sampath might see a faster repricing compared to some of these banks, although we do think that the overall sector as a whole we are quite bullish on the whole sector. There's also a question in terms of the apparel sector and whether we think this is a good point for entry. So right now, based on the conversations that we are having with a lot of the companies, they're still, in terms of the global conditions, are still quite muted. And they are kind of finding it difficult to kind of deal with certain orders that have been placed already. So we don't necessarily think right now might be a good time to enter unless you're willing to hold for a little bit longer, because of course, a lot of these counters have fallen in terms of their share price. So if you're willing to hold on, and if your investment period is longer, this is a good time to enter. But in terms of a turnaround for the sector, it might be a little bit later and you might not see that return coming in as immediately. So there's a comment on turnover. So turnover has been less in the last few months in the CSE. And do we see an increase in turnover considering the high taxes that are still prevailing? Yes, we do think that turnover will start picking up much more strongly. I think the last 2 to 3 months, I think particularly since the start of May, which is when there was a delay in terms of the finalization of the domestic debt optimization programs. It was initially supposed to be finalized in April, but because of that delay, we saw the turnover really kind of dropped in the last 2 months. But now with clarity being provided on that front, there is quite a bit of space in terms of turnover picking up, and quite strongly now because interest rates are falling again. That liquidity shift from fixed income to equities will also help turnover overall. In terms of our expectation on the 1-year Treasury bill, we expect it to be around 12% levels by the end of 2023. So in terms of the yield curve, it might still be relatively flat. So we're expecting probably around between 10 to 15% on the overall yield curve, but in terms of the 12-month T-bill, we would be expecting it to be at about 12%. There's a question on whether if China does not help in terms of debt negotiations in the coming months, if there's a threat to the market. So overall, I think if we go by the lines of Zambia, which 2 weeks ago were able to kind of secure their negotiations on the external front, this is again with a deal that they have to make with China as well. We take that as a positive sign for countries like Sri Lanka, who have done their part in terms of the fiscal side as well as in terms of the domestic debt side, are going into these negotiations. And I think the progress that we made on the external side is looking quite positive. Of course, we can't necessarily say what exactly the terms of things are, but I think the domestic data optimization proposal gave us a little bit of a hint in terms of what they might look like. Of course, if China does not agree, that would become a problem. But right now, given the evidence of, for example, Zambia getting the agreement through in the last 2 weeks, I think if we go by that, we would be more positive for the fact that China would also agree to some kind of a restructure of their debt as well. There's also a question in terms of our expected forecast for the USD. So right now we would be expecting a little bit more depreciation pressure, but again, not very strongly. We would go with a range of about 320 to 340. I think there's still a little bit of volatility in the market of trying to find that right equilibrium overall. But as I mentioned, we have to, for example, pay off the Bangladesh swap of about $250 million around August and September. We'll have to start making certain amortization payments on the debts once the external debt restructure is finalized. We also have liabilities to pay off in terms of the ACU side. Of course, there are investments on the inflow side that can also, to some extent, balance it out. But net, we do think that there's a little bit more depreciation, and the 300 to less than 300 levels was a bit of an overshoot in terms of the appreciation that we saw. There's a question on how the DDO impacted in other countries. I'm not sure if the question is actually referring to other countries and their financial sectors, or whether it refers to other counters other than the financial sector. I think broadly, in terms of other counters other than the financial sector, I don't think it has really much of an impact in terms of the performance of companies in a top line basis. But again, in terms of interest rates, because there has been that risk premium that was attached to interest rates that made companies investing or kind of going forward with further investments being a lot harder, finance costs being much higher, that affected companies. And right now we see that impact wearing off. And as a result of that, indirectly basically from the DDO finalization coming through with interest rates coming down, you see companies benefiting from being able to kind of pursue the larger scale investments that they would have delayed in the last year or so, and reduce their finance costs overall as well. And also, again, in terms of consumer spending power, the ability to borrow with lower interest rates also helps in terms of improving demand conditions and overall volume growth. There's a question, I think a broader question in terms of whether we expect any future income tax changes. We don't really expect any future income tax changes, at least not within the next 2 years. We do think that these higher tax rates can prevail. If they are able to increase the tax net, this provides it space to reduce the income tax brackets or lower the income, or rather widen the income tax brackets and bring down interest rates. But this is something that I think they will wait to see some of the income tax numbers coming in before they make a change on this. But we don't expect it to increase from this point onwards. There's another question in terms of the banking and financial sector counters have already reacted to expectations of a DDO. Can you expect short-term price corrections in these particular counters? Yes, I do think that despite there being a bit of movement in the last couple of weeks, that the full impact of it has not been factored yet. Right now, you're seeing that risk completely kind of being taken off, which was speculation prior to this. So there is a lot of space, as I mentioned. The banking sector is trading at 0.4 times book versus a historic average of about zero point 0.7. So even if this does not correct to 0.7, because, for example, of regulatory forbearance measures and all of that that have been taken, and a general risk on the sector, even if it moves to 0.6 times, there's still a considerable upside for most of the financial sector counters. So there are two questions on the domestic debt restructure, and I think with that, I will come to a close in terms of my Q&A session. As I mentioned, if you are not already a client of Capital Alliance Securities, we will have a quick explainer session, which will take about 5 to 10 minutes in terms of how you can sign up right after this. But the questions are basically if there's any circumstance in which there could be a derailment on the domestic debt restructure, and another question kind of be in line with that, asking if foreign creditors can decline the DDR options offered to them and any possibilities thereafter. So I think these questions are both in line with each other. Right now, I don't think there is necessarily a risk of a domestic debt restructure being changed due to external creditor negotiations. It's not something that we have necessarily seen in other countries. Of course, if there was no domestic debt restructure at all, that might have been a question. But right now, given that we will be hitting the IMF's targets in terms of the gross financing needs, using that select pool of bondholders, this improves our stance in terms of negotiation that we can see going into the with the external creditors as well. I think the fact that we can prove in terms of numerical perspective that this debt restructure alone is enough to meet the debt targets that the IMF has set in place will provide backing from the IMF as well in terms of going into those negotiations. So I don't think it's necessarily a point for external creditors in terms of bringing up that the DDO itself was not necessarily enough.
Thank you, Trisha. So being the first step of getting onboarded as a potential client with CAL is the account opening part. So I will share my screen and show you how you can open the account with CAL. Hope everybody can see my screen. So you can get open the account with CAL through two ways, either through the website or our mobile application, which is CAL Online, both Apple Store and Play Store, or you can simply enter portal.cal.lk. So then you will get the screen of which will let you sign in. So first, you will have to enter the part where you do not have an account. So that is the registration for potential investors. Once you click sign up, you will it will require to enter your national identity card number as a security login or your username. And then it will send your registered email address and your mobile number will be required. Once that is entered, you will be getting a OTP code, a one-time password to both your email and your mobile number. Once the verification code is verified, you can again sign into the application through the set credentials, which is your NIC as the username and the set password. Once signed in, this will be your screen. So it will have our main products, equity, unit trust funds, and treasuries. According to the client's requirement, you all can click on the relevant product, either it's equity, unit trust, or treasuries. It will all require the same amount of documentation. Only difference when it comes to a CAL Securities account is that the client will have to upload a selfie. That will have the instructions accordingly when you go to fill in the application. Once you click on the relevant product, it will have our basic terms and condition, which the client can read, agree, and continue. Once agreed, this will be your screen, which will have 9 tabs, 9 mandatory filling tabs. First will include your personal details, all general details, in order to be tallying with your entered relevant information, we will require a picture of your NIC to be uploaded, both your front and the rear side. That option will also be displayed, so where you can take a picture through the webcam by allowing access, or you can upload a pre-taken picture of your NIC, a clear picture of both the front and the rear side of your NIC. Then you will have to enter your contact details. And for address proof, let's say you are already residing in the NIC address, which is the address which is mentioned in your NIC, then you will not have to give us a billing proof additionally. If not, we have given the client the options of uploading a e-statement or a picture of the passbook, or a Grama Sevaka letter in that case, within the last 3 months. If it's the Grama Sevaka letter, then within the last 6 months. Once you upload the relevant address proof, then the next tab will be your employment details. You can enter all relevant information. Then we will require your bank details. In this part, you will have to enter your bank details and upload a picture to prove the relevant bank details. So that can be your e-statement or your online banking application screenshot, or the client can simply attach a e-statement or a passbook picture. So what we mainly check at this point is the bank's name or logo, the client's account number clearly being visible, and the client's name. So why this part is mandatory, just to give everybody an heads up, is moving forward when the client wants to make an investment or a redemption, we will be accepting funds from these registered bank account only to our CAL account, or securities or unit trust or treasuries. So in case if a client wants to have two bank accounts registered with CAL, at this point it will only let you enter one, but later once your account is open, you will always have the option of adding in an additional bank. So you can do dealings with both of the accounts. Once that is done, this the fifth tab will be to enter all details, basic details, whether they'll be asking whether you are a politically exposed party, and all the other compliance required basic information. Then we will display a pad where you can digitally place your signature, and then the eighth part is the video verification in order to be going ahead with the compliance requirement. So that is in the video verification, in case if the client is getting stuck, we also have a pre-recorded video which will be easy for you all to refer. Please do allow camera access to the device that you're trying to do the video verification from, and you will have to show the NIC front side, rear side, and read out the NIC name. So that is a automated 40-second video that we have set in the portal. So that will start when you press the start button, and the time will be descending. And once you show the NIC and the relevant billing proof and stop, a verification code will pop in the screen. Okay, like this, a verification code will pop. You will have to read out the verification, start the video again and read out the verification and submit. If the client is finding it hard, you can always restart the video and do the needful. The reading out of the verification and showing the NIC is mandatory, because this is a completely digital process for us for investors and the company to be a hassle-free onboarding session. Once all of these steps are sorted and filled, you can complete and submit the form. Once it's submitted, we will be getting all the information to our CRM team, which will usually take 2 to 3 working days, or mostly 3 to 4 working days, for us to do the needful, to do the relevant checks, and to see if all details entered are in accordance with the uploaded documents, the relevant PEP checks on, and all the compliance check. Once that is complete, the client will be receiving a welcome email from our end, which will have the client code and all fundamental guidelines on how you can start investing with Cal. In case during the process, if there is any issue, or if you're not sure whether all the information entered from the client's end is correct and accurate, we will be doing the needful from our end. And if there is an issue, we always send client an email to the registered email address, and a call also goes from our end to guide you further on the requirement, on the accurate requirement. So once that is done, once the resubmission is done, we will do the needful on our end. The relevant approvals will happen from Cal, and the client will be getting uh, the welcome email, and from there onwards you can start investing. Once the account opening is done, I'll quickly to show you all how it will be. So once everything is complete, this is how it will be showing. This is a test account. So accordingly, whatever the information that you have entered under the relevant product, it will show whether it's approval pending or your application in the draft stage. And once it's approved, you will, as I told earlier, you will be getting a welcome email as well. And you can start investing. In case if there is any issue, the client can always reach to us on 011-760-2525, which is available in our website. We also have a chat bot which will help you with fundamental. If not, all your deeper questions can be emailed to us through the CalI inquiry email address as well. So this is a completely digital process. 100% of the onboarding happens digitally. There are certain check after relevant checks. There can be an instance where we will need to see the NIC of the client. So that is a very rare scenario. If not, it's completely digital, and from creation to adding a bank to redemption, everything can be done digitally through the portal.